is joining us. He's of course the head of Research Institutional Equities from Motilal Oswal. Hi Gautam, good to be speaking with you. Thanks so much for making time and talking to us today. To begin with, the earnings season has been subpar, and we're all talking about those ratios of upgrades to downgrades. You have done the absolute number crunching here. Talk to us about what's your key takeaway of the earnings season, and going forward, which are the sectors that you think are poised for further upgrades or earnings surprise, if at all?
Hi, Anisha. Good morning. Thanks for having me here. Yes, you're right. The earnings season has been very soft, and after a very long time, we have seen downgrades being much higher than upgrades. So, if you look at it in absolute terms, so far this quarter for the coverage universe, which have posted numbers, which is upwards of 225 companies so far, the earnings are down 4% versus expectation of 1.5% decline. Of course, it is heavily influenced by the drag from commodities. If you exclude just the three OMC companies, the earnings are up 6%, right, versus expectation of around 5%. So broadly in line. And if you go a step further and exclude all metals and oil and gas, which is basically all commodity companies, then for about 205 companies that we track out of the 226 that I mentioned at the beginning, if you exclude those 21 commodity companies, earnings are up close to 10%, which is in line. So while earnings are soft and have seen a very distinct moderation across the board, the picture looks slightly better if you account for the big drag from a few of the commodity-oriented sectors. For Nifty also, the earnings are flat. But more importantly, the internals of the earnings are very weak. As you mentioned, we've got earnings of about 100 companies by more than 3% for FY25, and we have upgraded for only about 36, 37 companies. So that is close to 3:1 in favor of downgrades. Secondly, we've cut the earnings for Nifty also, the EPS, by close to another percent in the interim review that we did. This comes on top of the 3% or 3.5% earnings cut that we did at the time of preview. So net, if you see from April to November now, our EPS estimate for Nifty are down close to 8%, from 1,140 rupees to now about 1,060 rupees. Which basically means that FY25 is going to be just a 5% earnings growth year, right? We are not used to single-digit earnings growth for the last 5 years now. Between FY20 to 24, every single year was a double-digit earnings growth year, and we've had a 21% earnings compounding between FY20 to 24. So clearly, FY25 is occurring as a bit of an outlier in a 5-year, 6-year trend, where things are slowing down a bit. There's moderation, there's a breather. And of course, it's also a reflection of the government spending being down. First half, the government spending is flat. Capex spending is down 17%. So let's hope that second half, the government spending picks up, Capex spending picks up. There's been a good monsoon. So consumption, which has been the weakest point in this earnings season, also revives a little bit because the Kharif crop should be good. So these are the things as we stand here. As regards your question on sectors, so in this quarter, we have seen very strong performance from PSU banks. In fact, they are the only component of our coverage universe where we have seen 6 out of the 6 PSU banks that we track have beaten our expectations. Apart from PSU banks, healthcare has been good. They've also met expectations. Real estate has been very good. And then IT has been in line. And you can say even consumer was in line, but very soft. It was very soft. We were expecting 3% growth. We got 0. So very few, happy pickings in this broad spectrum of sectors that we cover. Apart from PSU bank, healthcare, and real estate, very few sectors have posted a double-digit growth.
Okay, fair enough. Gautam, let's get in your take then as to how you're looking at the entire, pickup in Capex, and how you're reading into numbers from some of the engineering companies within that space. How you're looking at the overall order pickup. What is it that you would have liked to see in the earnings that perhaps was a miss this time around?
So, look, in the capital goods and industrials universe that we cover, the numbers have been better than expectations. That's because of, few of the heavyweights like L&T, where the expectations were very low, and they've managed to, beat those expectations. You've seen good numbers from Cummins. The only miss was, I think, ABB. So overall, in an otherwise very soft scenario, and top down also Capex being down, at least this quarter, the impact is not so clearly visible. That's why I mentioned if October onwards, the government machinery starts spending, Capex spending starts reviving, expecting. Because look at the numbers. Government has budgeted for 11.1 lakh crore of capex spending this year. First half, which is April to September, the total capex spending was down 15 to 17%. Whereas the full year expectation is that, as per the budgeted number, it should grow 17%, which essentially implies that for the second half of FY25, the capex spending has to go up 52% YOY, which is very difficult in my view. Even if it goes up 30-40%, it will provide very strong legs to the execution and order book. So any correction, we are very positive on industrials. We have a big overweight there. We have L&T, we have ABB in our model portfolios. So any correction there because of this quarter or 2 quarter of weak earnings, we would suggest to buy into it, provided you have at least a 3 year of a horizon. Because this government has been very clear in the last 7-8 years. They've been very pro capex, pro manufacturing, pro infrastructure creation. So any blip that you get on a quarterly basis in earning, I would think it's a buying opportunity.
Right. Gautam, the other thing I wanted to talk about is the underperforming pockets. Pretty much all of consumption has been subpar what the street was anticipating. You think much of the pain is in the price, especially for some of the paint and FMCG categories? And do they now become attractive buys, or do you think the pain is going to linger on for the next few quarters?
So Aisha, good morning. See, consumption is a very broad ocean now. It's no longer just FMCG. You have at least 10 subcategories in discretion apart from staples, right? So staples has clearly slowed down, and the signs were visible even a few quarters back when you are seeing that urban growth was coming off. Today, we are at a situation where, as per the Nielsen or I think some other syndicate data which has come out a couple of days back, the urban growth has come down to just 2.8% at a very top-down industry level, which was 11% a year back, while rural is recovering after 2.5 years. What is in the price? Some of it is in the price. But to expect that there is going to be a very sharp recovery in consumer sector volume growth will not be correct in my view, because the wage growth, the other internals, because if capex has slowed down in terms of the overall government spending, the trickle-down effect of that reflecting in consumption is also going to manifest with a quarter or two of lag. Secondly, none of the companies which have reported so far have very emphatically said in their conference calls that third quarter is looking extremely strong or October looking extremely strong. That's not a commentary that we got. Most of the companies are saying that things are picking up segment to segment, geography to geography. So I think this pain can linger on for a couple of more quarters. I think a lot more needs to be done, not just at the sector or company level, but I would say even at government level to revive the consumption. Now, within that, we'll still look at a lot of bottoms of opportunities. Jewelry is a segment that we like. So we've been holding Titan, Kalyan in our model portfolio for some time now. Hotels is a very strong sector, I would think. We've been holding in Indian hotels from 100. They posted a very good number quarter. And I think the upcycle in hotel, we still have 2-3 more years of cycle left there, because they've gone through 10 years of a down cycle, and we are just in the 3rd or 4th year of an upcycle. Plus, the demand-supply gap is very favorably poised in favor of the hotel players. So there are a lot of sub-segments. We like the food delivery segment, things like Zomatos and all, but we are not positive on QSR. So in consumption, you have to take a very bottoms-up, sector-specific, company-specific view, rather than painting it with a very broad brush, because you will make mistakes in that. Because staples is something which is clearly very subpar right now, and it's going to take time in my view.
Okay, so other than a Zomato and your thoughts on FMCG, tell us your, say, top 5 to 10 holdings or recommendations within the entire consumption basket.
So Aisha, I'll just put it differently. We've been significantly overweight on consumer discretionary in our model portfolio for the last 3 years now. Staples has been an underweight. In fact, except Hindustan Lever, we still don't have any other consumer staple name in our model portfolio. But our portfolio is full of discretionary names like Titan, Zomato, Indian Hotel, Metro, Selo. So those are the names that we've been holding. Even there, we've cut some weights. For example, in discretionary also, we used to hold around 11 total consumption stocks, out of which 9 were discretionary till July. Now we have brought down to 6 or 7 now, right? So consumption we have brought down from overweight, big overweight rather, to neutral. We are more positive on IT, we are more positive on private banks, we are more positive on real estate and industrials, which is where we have increased our weight. In fact, private banks, we've raised to overweight after 2 years in our October preview. Tech, which we were underweight till April, we made it overweight in July. In October, we made it even bigger overweight. So in tech, our weight has doubled in last 6 months. So we are not necessarily very positive across the board on consumption. It's select pockets and discretionary where our preferences lie.
Very selective when it comes to consumption. I wanted to take the conversation back, Gautam, to the fact that you said that you've cut the Nifty EPS estimates to 1,060 thereabouts versus 1,140. That means that we're still trading at 20 to 23 times forward earnings. Is there any scope of a valuation expansion, because earnings are clearly getting derated? What then will perhaps provide the leg up to the Nifty, because right now we're at 20 to 23 already?
Yes, Anisha, and I don't think there is room for earnings of valuation re-rating or PE multiple expansion, because clearly what has happened, if you see last 6 months, earnings have got cut by 8% from 1140 to 1060. And Nifty has also seen an 8% downtick. If you look at the 52-week high, I think it was somewhere about 26,200. Right now, we are at 24,200 or 300, that range. So earnings have been cut by 8%. Nifty has also seen a 8% cut, which essentially means that your P ratio has not seen any derating in the last 6 months. While index has come off, it is entirely driven by the earnings cut. In fact, your mid-cap, small-cap, broader markets are still trading at a very expensive valuations. If you look at the mid-cap index P, the NSE 100, which 2-3 months back was trading at 35 P, is now down to 30. But it is still at a 25-30% premium to Nifty. This premium was obviously 60%, which was clearly unsustainable in our view, because it has never traded at that kind of a premium for any long period of time in the past 2 decades. Even now, after the correction, at an index level, the mid-cap index is still trading at 30% premium to Nifty. So yes, Anisha, the growth, or rather the returns from here, even if you talk about large cap, will entirely be a function of how much earnings growth you get over the next 2 years. We're expecting about 16 to 15% earnings growth in FY26. FY25 is 5%. FY25 ex of commodities 10%. So that 10% we're expecting it to move towards 15-16%. So in fact, I would say that if next 3-4 months Nifty doesn't go anywhere and consolidate in this range, at least it will provide some cushion for valuation to move up in the next 24 months. Because we've had a phenomenal last 2-3 years in the broader markets. Of course, Nifty has been very subdued. Today, if you look at Nifty, the trailing 3-year returns, that is October 24 or November 24 versus November 21, Nifty has given you just 11% 3-year compounding, whereas mid and small cap has given you 21 and 23% compounding on a 3-year basis. So from here, room for valuation expansion is extremely limited, and will be a function of how much earnings growth you're able to derive from any index.
Okay, Gautam, so great to have you on the show. Thanks as always for taking the time out and speaking with us today.
Thanks, Ash.
Okay, that's the word coming in on the market. By the way, the Nifty is absolutely flat.
If you like this video, then like, share and subscribe to ET Now.